Today is Friday, June 10th. I want to take a look at some ratios in the stock market today, or just in markets in general. And these are not fundamental ratios like price earnings and sales and things like that. These are ratios that are pretty much produced by the market itself, ratios of how things are trading versus each other. We'll start with a familiar one. This is consumer discretionary divided by consumer staples. We do that in Technician over here by putting a colon between the two symbols. So you get XLY over XLP this way. And here you can see the ratio, big decline at the end of last year into the February low. Then of course a big rally in the stock market, and consumer discretionary was leading the way. That obviously has changed. It failed at its own 200-day average. Now it's below its 50-day. And if you like, we can draw a little neckline in here for a head and shoulders pattern. I don't know if I'd call it that because it's not really reversing any trend. But still, it is a support break, and it tells us that consumers are a little less aggressive, a little more conservative right now, and the stocks are showing that. And just for kicks, let's just take a look at these ETFs on their own. Let me get some other ratios in here. You can see price relative. This is the consumer discretionary versus the market, and it's been falling all year actually. And here on-balance volume also falling. So despite this big rally, the net trend in on-balance volume is down. XLP is next. Look at that, a new high this week, obviously outperforming it. Still not very good this is the on-balance volume. It's not outperforming it. So what this tells us is that consumer stocks in general are not leading the market right now. But out of the two types of consumer stocks, the more conservative ones are better in terms of trend than the more aggressive stocks. Let's move on to stocks versus bonds. This is the SPY, the S&P 500 ETF, versus the AGG, which is an aggregate bond market type of indicator. Kind of looks like the stock market here, the ratio. So it's still in a rising trend. I'm going to get rid of that here. And I'm also going to get rid of this and put an RSI in there just to give us an idea of momentum. You could choose any momentum indicator you like. Looks pretty modest and actually heading lower. So I don't know how much momentum is left in this thing. If this is going to turn into a double top here, I don't know. But so far, stocks are beating bonds. Why is that? Because stocks have this huge price and it can move a lot, and bonds have this small price range. So we're going to take a look at the bond market later. But right now, this ratio is probably what's keeping the bulls alive right now. All right, next one. Junk bonds versus high-grade corporate bonds. The overall trend still down. Here are the moving averages. Could put a little trend line in here. So junk hasn't broken down versus high grades just yet, although the overall trend is still down. It hasn't broken this 200-day average for sure. So this is kind of a sign that if you're a bull in the stock market, you're hanging your hat on this one as well. Let's look at corporate bonds versus treasuries. So this shows us that corporates, which have a higher risk profile than treasuries, of course, heading down versus treasuries. And look at this down here. It's hard to see in this ratio chart. Actually, let's make it a little easier to see by making it a line chart. That looks like a breakdown of this rising trend this year. So here we have the shift away from even though they're high grade, the riskier corporate bond versus the treasuries. The last one we'll look at here, this is copper versus gold. It's more like if you strip out the dollar and the fact that these are both metals, which one is more economically sensitive, which one is more of a hedge, more of a fear type of thing. And you can see that copper is clearly heading down. It's making new lows actually versus gold, making new lows here. So this is kind of bad for the economy, probably for the market as well. So it's a slightly mixed bag here. Stocks still beating bonds on that one ratio, but junk bonds just barely holding on versus high grades, and corporates in general lagging treasury bonds. So these are a couple of the ratios I look at in the stock market to get a handle on the stock market, and I think overall they don't paint the greatest picture.